Hi, Alan Stratton here from CostMatters.com. I received a telephone call today from a salesman. Normally, I would have cut the call short, but today I was out getting some exercise, and since it was light exercise and I wasn't breathing hard, I decided to listen to his presentation. He was pitching business services. First, did I have a business entity for my business? Apparently one of their services was forming entities. Well, I have an appropriate entity, so we went on. Next was business financing. This was more interesting. He went through the typical statistics. He went on about the number of businesses that fail in their first year or years and why, and how most often it was not a problem with the business concept, but it was a problem with their financing. Well, so far I agree, but wait. According to him, it was not really a financing problem. In reality, he said the problem was their lack of planning. This was a new twist on the usual story. We've all heard stories about great businesses that grow very rapidly and then run out of cash. His twist was that these businesses would not have run out of cash if they had planned ahead for their financing. This was a new twist on the usual story. At first, as I thought about it, I was tempted to reject his angle and argue that, in reality, the problem was indeed cash flow. Then I realized that I partially agreed with him. Our point of agreement centered on business planning. With an effective business plan, we should be able to anticipate our business cash needs and arrange loans, equity, or lines of credit to smooth out our cash flow. Of course, an effective business plan requires us to understand both our revenue and our costs. Now, this is not just a numbers exercise. We need to know what we will do with significant changes in the business. Not all plans work out. During the recent financial crisis, the government put the banks through a stress test. While you may argue about the merits of the Treasury's test, we can observe a useful technique here. How about stress testing our own business? Can we be honest with ourselves? One test may be to increase sales by 20% or decrease sales by 20%. What happens to our cash flow? Another test may be to delay receivable collections by a month or two. Now, if that happened, are we still in business? Okay, so planning that includes a financing plan may definitely help. However, then I recalled conversations with a banking friend who is working with problem loans. He's able to cite numerous examples where companies had a plan and did obtain financing. They're problem loans now. Okay, so what they did was what the salesman was recommending. However, in these cases from the bank, the company's plan was not realistic. Despite having a plan and financing, they were not making their payments. In one case, their plan had assumed significant increases in customers that did not materialize. In retrospect, the plan was not realistic for the business location and the environment that they were in. So, even planning and financing were not enough to keep them in good standing with the bank. So, my thoughts circled back to understanding where, how, and why a business spends money in comparison to where, how, and why a business collects money. It is not enough to have a great idea and great prospects. Great ideas and great prospects must be backed up with an understanding of business expenses and the behavior of the business expenses. Now, by behavior, I mean how expenses relate to volume, how they relate to time, how they relate to vendors, to employees, to customers, and so on. So which is it, cash flow or planning? Actually, it sounds like a chicken and an egg problem. I say both because cost does matter. Do you have other great examples of this situation? Please share below. Please remember that cost does matter to your business profitability. I am Alan Stratton from CostMatters.com. Thank you.